Welcome to the ProTicker Deep Dive.
Good to be here.
It is Tuesday, February 17th, 2026. And, coming back from the President's Day holiday, looking at the screens this morning,
Yeah.
wow,
Wow is a good word for it.
the mood has just completely shifted. It's
Wow.
not just that the numbers are red, though, let's be clear, it is a sea of red out there.
It's wall-to-wall red.
But it's the texture of the selling. It just feels different this time. We're seeing U.S. stock futures slipping right from the get-go.
Right out of the gate. There was no morning pop, no attempt to rally, just down.
And the Nasdaq is staring down the barrel of its fifth consecutive weekly loss.
Which is significant. I mean, really significant.
It is. If that actually holds through Friday, we are talking about the longest losing streak since the depths of the 2022 bear market.
That's right. And, people have memories of that. That wasn't that long ago, so it feels heavy. It feels like the market woke up from a long weekend with a massive, massive hangover and realized the party might actually be over.
That's a perfect way to put it. It's a very heavy tape. And you're so right about the texture. It's not that chaotic panic selling,
No, it's not the VIX at 50. It's not screaming on the floor. It's methodical. It's almost structural. It feels like a fundamental repricing of reality is underway.
Exactly. And as we were looking through the research pile for today's deep dive, a very, very specific theme started to emerge from all these different stories. For the last, 3 years? Really, since 2023? We've been in this cycle of just absolute euphoria around artificial intelligence. You could call it the infatuation phase.
Oh, absolutely. The buy everything phase.
Yeah.
If a company had a chip, you bought the stock. If a CEO so much as whispered Gen AI on an earnings call, the stock would pop 20%.
You could double your position, right?
Yeah.
But the core thesis for what we're talking about today is that the honeymoons is officially, and I think brutally, over. We have moved from infatuation to interrogation.
Interrogation is the perfect word for it. I mean, think about the psychology of the market from, say, 2023 all the way through 2025. What was the question everyone was asking?
How big can this get?
Exactly. How big is the total addressable market? It was a game of pure imagination. And when you're just dreaming about the future, valuations can basically be infinite because the possibilities seem infinite. It's all blue sky.
But interrogation, that sounds much more hostile. It sounds like we're in a dark room with a single bare light bulb swinging back and forth.
It is hostile. The entire question is flipped on its head. It is no longer how big is the market. Now, the market is looking at companies, especially these comfortable legacy companies that have been around for decades, and it's asking, what is the blast radius?
Wow.
The market isn't really looking for the winners anymore. It's aggressively, actively hunting for the victims. It's trying to find those old school business models that AI might just render completely obsolete, and not in 10 years, maybe in 10 months.
And this isn't some hypothetical, what-if scenario we're talking about today. We're looking at an absolute bloodbath that happened just before the holiday weekend in a sector that most people would never associate with high-tech disruption.
No, not at all.
We're talking about trucking.
A sector that got absolutely decimated by a press release about an algorithm.
It's unbelievable. So we're definitely going to unpack that trucking crash because I think it's maybe the most important signal in the market right now. We're also going to look at a so-called tax bot that has wealth managers just sweating through their suits. And of course, we have to talk about the Judgment Day earnings that are coming up for NVIDIA and Palo Alto Networks.
And it's all connected. The whole thing is like a game of whack-a-mole.
Yeah.
The market just sees a new head pop up, a new intermediary, a new middleman, and it just swings the hammer.
So let's get into it. But before we get to the specific casualties here, I think we have to set the macro table because the technicals on the charts themselves are deteriorating in a way that really suggests the machines are in control of the selling now.
They absolutely are. And for you listening, if you don't spend your day staring at candlestick charts or Fibonacci retracements, we need to explain why these specific lines on a chart actually matter. We're not just reading tea leaves here.
Right. This is about mechanics.
It's pure mechanics. The NASDAQ 100 has officially broken below its 100-day moving average, and the S&P 500 has slipped below its 50-day moving average.
Okay, so let's break that down. For the listener who's maybe an executive, not a day trader, why does crossing some arbitrary line like the 50-day moving average suddenly trigger billions of dollars in selling? Why should they care about that specific line?
It matters because of who, or more accurately, what is doing a huge chunk of the trading. A massive amount of market volume these days is driven by something called CTAs, that's commodity trading advisors.
These are the trend-following funds.
The big ones. And these are algorithms. They are completely and totally agnostic to the story. They do not care about AI. They don't care about earnings reports. They don't care who the president is.
They just care about the math?
They care about momentum mathematics. That is it. They are essentially giant if-then statements running on supercomputers.
Okay, that makes sense.
So for weeks or months, when the price is trending above that 50-day average, the algorithm's simple logic is trend is up. And so it buys or it holds its long positions. But the second the price crosses below that line, the logic switch just flips. It immediately reads, trend is broken.
And it doesn't hesitate.
It doesn't ask why, it doesn't call a committee meeting, it just executes a mechanical sell order to flatten its position and reduce risk. It creates an air pocket in the market. So when we cross these big technical thresholds, you get this cascade of selling that has literally nothing to do with company fundamentals and everything to do with these giant risk models deleveraging all at once.
So you've got the machines selling just because the math tells them to. But then you also have the humans getting nervous because of the Fed. And we got a massive curveball over the weekend about the Federal Reserve Chair nomination, didn't we?
A huge political and economic curveball. President Trump has nominated Kevin Warsh to be the next Fed chair.
Kevin Warsh. Now, that name definitely rings a bell for Fed watchers from, the 2008 era. But he is not exactly the lower rates forever kind of guy, is he?
Not even close. No, he is arguably the most hawkish candidate on the entire shortlist. And this just throws a massive wrench into the market's prevailing narrative.
The whole story has been rate cuts.
The entire bull case for early 2026 was completely predicated on this idea of a lower for longer rate cut cycle. The market needs that liquidity. It needs that cheap money to keep flowing to these really capital-hungry tech companies. Warsh historically has been extremely critical of the Fed's easy money policies, especially quantitative easing.
So the market hears the name Warsh, and the immediate translation is the punch bowl is getting taken away right when the party is getting weird.
That's it, exactly. And what's so fascinating is that this narrative is taking hold, even though the data, the actual, economic reality on the ground is telling a totally different story.
Right. We just got the January CPI numbers.
And they were good. Inflation came in at 2.5%. That is cooler than analysts expected.
Which should be bullish news. I mean, inflation is coming down. The economy is still holding up. Why isn't the market rallying on 2.5% inflation? That's practically the Fed's target.
Because of the interrogation. The market is completely ignoring the good macro news because it is absolutely terrified of the micro disruption. Let me put it to you this way.
Okay.
If you are a freight broker or you're a tax accountant or an insurance agent, does it really matter to you if interest rates go down by 25 basis points if your entire business model just got evaporated by a new piece of software?
No, not at all. Cheap money doesn't help you if you have no customers left.
Correct. The existential risk of AI displacement is now outweighing the marginal benefit of slightly cheaper capital. The market is shifting its focus from what is the cost of money to what is the fundamental viability of the business itself. And that brings us directly to the trucking story.
Let's dig into this because it's just so stunning. When we talk about AI disruption, we usually talk about graphic designers or copywriters or maybe some junior coders.
Like color knowledge work?
Exactly. We do not talk about 18-wheelers. But on Thursday, February 12th, so just before everyone headed out for the long weekend, the Russell 3000 trucking index dropped 10% in a single day.
10%. For a sector that's supposed to be like a utility? I mean, that is not volatility. That is a full-blown crash.
And when you look at the specific names, it's even worse. C.H. Robinson, worldwide a giant in the space, plunged 24%.
24%.
Landstar System fell 19%. RXO Inc. was down 20%. These are the blue chips of logistics. These are the companies that literally move the physical economy. What on earth happened?
A very small AI-native startup that most people had never heard of, called Algorithm Holdings, unveiled a new tool, and that tool is called SemiCab.
SemiCab. Okay, I need you to walk me through this. How does one startup with a new app destroy a quarter of the market value of C.H. Robinson, a company that's been around since 1905?
Yeah.
What is the secret sauce here?
To understand that, you have to understand the core inefficiency of the entire trucking market. It is plagued by a problem called the empty mile.
The empty mile. Okay, define that for us.
It's exactly what it sounds like. A truck picks up a load of, say, widgets in Chicago, it drives them down to St. Louis and drops them off. Great. Now the truck is empty.
Right.
To make money, the driver needs another load, a backhaul. But often, the next available load is 100 miles away in a different city, or maybe it's all the way back in Chicago, so they have to drive that truck empty. They're burning diesel, they're burning time, they're burning wages, and they are generating zero revenue for those miles.
It's just pure waste. It's bad for the environment, it's bad for the driver's wallet, it's bad for the shipping company.
It's a massive, massive waste. Industry estimates say that somewhere between 20 and 30% of all miles driven by commercial trucks are empty miles. Now, the entire job of a company like C.H. Robinson, a freight broker, is to try and minimize that.
They're the middlemen.
They are the ultimate middlemen. They sit in the middle with this massive network of shippers on one side and drivers on the other, and they try to match them up. They're on the phone all day saying, hey, you're in St. Louis. I've got a load of car parts here that needs to go to Nashville.
And for that service, for that coordination, they charge a hefty premium.
A huge premium. It's called the broker spread. They are essentially arbitraging information and complexity. They have a giant database of where all the freight is, and the individual truck driver doesn't. They handle all the phone calls, the paperwork, the price negotiation. It's a very human-intensive process.
Enter SemiCab.
Enter SemiCab. Algorithm claims that this tool utilizes a brand new class of agentic AI to solve this complex routing problem dynamically across the entire network at once. They aren't just matching one driver to one load, they're apparently optimizing the entire grid of thousands of trucks and loads simultaneously in real time.
So it's like a hyper-efficient, automated air traffic control system for every truck on the road.
That's a perfect analogy. And the one stat that absolutely terrified Wall Street, the single number that caused that 24% drop in C.H. Robinson, is that algorithm claims SemiCab can reduce empty miles by 70%.
70%? That sounds, is that even physically possible? That seems unbelievably high.
The market seems to believe it's possible, or at least it fears that it is. And if you can actually reduce empty miles by 70%, think about what that means. You are effectively creating new shipping capacity out of thin air. You make the existing fleet of trucks 30 or 40% more productive without adding a single new vehicle to the road.
Okay, but here's the skeptical question. We've heard this story before, right? Uber Freight promised to disrupt this industry years ago. Amazon Freight came in with a big splash. They all promised to use tech to fix this. Why is this specific announcement causing a panic now? Why did the market basically shrug off Uber but completely panic at algorithm?
That is the key question. And the difference, I think, is the agentic nature of the AI they're describing. Previous attempts, like Uber Freight, were essentially just digital marketplaces. They were like Tinder for trucks.
Right. You just swipe to find a load.
Exactly. But you still needed humans to check the app, to accept the load, to negotiate the price, and very often a human broker was still involved in the background, smoothing things over and making calls. SemiCab claims to automate the entire negotiation and execution process. The AI agent isn't just showing you the optimal load, it's autonomously booking it, pricing it, and routing it instantly.
So it completely removes the friction of the human broker from the equation.
And if you remove the human, you destroy the margin. If an AI can match the freight instantly and perfectly, why would a shipper ever pay C.H. Robinson a 15% commission to do it slower and less efficiently?
It wouldn't.
The interrogation here was just brutal. Investors looked at C.H. Robinson's business model and had this sudden, terrifying realization that their competitive moat wasn't their relationships or their scale. Their moat was inefficiency.
Wow. That is a harsh, harsh realization. Their entire business model was built on the fact that the market was messy and complicated, and you needed a human guide to navigate it. If the AI comes in and cleans up the mess.
You don't need the guide anymore. Precisely. C.H. Robinson is selling a very expensive solution to a problem that AI just solved for close to free. That is why the stock collapsed. It was a rapid repricing of their terminal value down to zero, or at least to a much, much smaller number. It's a classic disintermediation event.
Disintermediation, the removal of the middleman. And it's just so clear that this isn't just about blue-collar logistics. We are seeing this exact same dynamic play out in what is arguably the most white-collar profession imaginable, tax and wealth management.
Yes, and this happened just 2 days before the trucking crash. It was like a warning shot. It was a clear signal of what was coming. On February 10th, Raymond James Financial fell nearly 9%.
Huge move for a company like that.
Charles Schwab was down over 7%. LPL Financial dropped more than 8%. These are the titans of the wealth management industry.
And again, just like with the truckers, the catalyst wasn't a bad earnings report. It wasn't some big scandal. It was a tool.
A tool called Hazel, which was launched by a fintech startup called Altruist.
Hazel? It sounds so friendly, like a nice aunt who bakes you cookies. But apparently, Hazel is an assassin for financial advisors. What does this thing do?
It directly attacks the core value proposition that advisors have been using for the last decade, which is alpha through tax efficiency.
Hmm.
See, for a long time, financial advisors have had a really hard time justifying their, say, 1% annual fee just by picking stocks.
Right, because we all know that most actively managed funds can't beat a simple index fund over time.
Exactly. So the entire industry pivoted its sales pitch.
The pivot was, I don't just pick stocks for you, I manage your holistic financial life.
That's the one. I charge you 1% because I save you more than that in taxes. I do sophisticated tax loss harvesting. I do estate planning. I optimize your asset location, telling you what to hold in your IRA versus your taxable brokerage account.
I am your sophisticated tax strategist, and that's worth the fee.
Exactly. So enter Hazel. Hazel connects directly to all of your accounts and uses AI to generate these personalized tax strategies. It can execute tax loss harvesting automatically, and it can even generate the complex documents you need for filing. It does the sophisticated work of a CPA and a certified financial planner, and it does it instantly.
So if I'm a client and I see that this Hazel tool costs, I don't know, a flat fee of $50 a month, or maybe it's just embedded in the platform for free.
Then you have to ask yourself, why are you paying a guy in a suit 1% of your $1 million portfolio, that's $10,000 a year, to do the exact same thing that a bot is now doing?
This is the fee compression that everyone's been talking about for
Ugh,
years.
this isn't fee compression, this is fee obliteration. The market is looking at a company like Raymond James, and it's asking, if your value proposition is just relationship management, that's fine. People will pay for that. But relationship management isn't worth 100 basis points a year.
Oh,
The margin for the actual work is going to get crushed down to zero.
it really seems like the common thread between the truckers and the wealth managers is this idea of information arbitrage.
Absolutely.
Whether it's knowing where a truckload is or knowing a specific tax loophole, these industries existed and thrived because the professional knew something that the customer didn't.
And AI just democratizes that information completely. We saw the exact same thing happen in the insurance space with Willis Towers Watson dropping 12% because of a startup called Insurify.
What's their angle?
Insurify uses a ChatGPT-style interface to instantly compare dozens of complex auto insurance policies. It reads all the fine print that the human broker used to read for you and charge you for. When the client has the exact same information as the broker in real time on their phone.
Then the broker is just a toll booth.
And people hate toll booths. People will go to extraordinary lengths to find a way to drive around a toll booth.
So, okay, we've clearly identified the victims. The market is out there hunting intermediaries. But let's pivot for a second to the companies that are supposedly selling the shovels for this whole gold rush.
The enablers.
Right. Usually when this AI is taking over, narrative heats up, the big tech stocks just soar. But that is pointedly not what's happening this week.
No, and that is precisely why this moment feels so different. The interrogation has now reached the generals. It's not just about the foot soldiers anymore. And we have two massive, massive tests coming up. Palo Alto Networks reports today, and then the big one, NVIDIA, is next week.
Let's start with Palo Alto. They report today after the bell. The stock is already down about 9% year to date. What is the friction point here? They're supposed to be the leaders in AI-powered cybersecurity.
The friction is all about their strategy of platformization.
Which is corporate speak for what exactly?
It's aggressive bundling. Palo Alto has been going to large enterprise customers and essentially saying, stop using 5 different security vendors. Stop using CrowdStrike for your endpoint security and Zscaler for your network access. Just use our one integrated platform for everything.
And to get them to switch?
And to get you to switch, we will give you the product for free for an initial period.
Free? That sounds... Well, that could either be extreme confidence in your product or it could sound like desperation.
And that's the debate. The bulls on Wall Street call it strategic consolidation. The bears call it buying revenue. And the market is now interrogating that strategy. They want to know, is this actually leading to large, profitable, paid contracts down the line? Or are you just churning through free users to make your top-line numbers look good?
So proof is in the pudding with the guidance they give today.
Exactly. But the really interesting thing I think you should watch for in their report today is a new feature they've launched called MZIAM 2.0.
Rolls right off the tongue. Very catchy.
A terrible name, but a fascinating product. It includes something they're calling a 250-hour breach response guarantee.
What does that mean?
Essentially, they are using their own AI to automate the response to a cyber attack. They are claiming their AI can identify a threat, contain it, and neutralize it faster than human security teams can. They're so confident they're putting a guarantee on it.
They're automating their own high-margin services layer.
They have to. There is a massive talent shortage in cybersecurity. You literally cannot hire enough qualified humans to sit there and watch the screens 24/7. So Palo Alto is trying to prove that AI allows them to scale their revenue without having to scale their human headcount. If they can prove that model works, the stock works. If it just looks like another expensive cost center, they're going to get punished.
But the main event, I mean, the Super Bowl of this market, and maybe the whole year, is NVIDIA next week.
February 25th. Mark your calendar. The entire market is effectively a derivative trade on NVIDIA at this point. If NVIDIA sneezes, the S&P 500 is going to catch a severe cold.
And the expectations are just terrifying. Analysts are looking for, what, $1.45 in EPS? It's up 70% year over year. The revenue numbers they're projecting look like typos. They are so big.
And therein lies the problem. Great is no longer good enough for NVIDIA. Last quarter, they beat earnings estimates, they beat revenue estimates, they raised their forward guidance, and the stock fell 3.2% on the news.
That is the absolute definition of an exhausted trade, when fantastic news is treated as bad news.
It's the definition of the interrogation phase. Investors are now looking past the raw chip sales numbers. They're looking at the customers who are buying the chips. We all know that Meta and Google and Microsoft are in the middle of this $500 billion CapEx cycle, buying these new Blackwell chips. The question the market is asking now is, are they making any money from it?
Right. So if C.H. Robinson goes bust because of some new AI tool, that implies that someone, somewhere, bought an NVIDIA chip to build that tool. In a way, that's good for NVIDIA.
In the short term, yes. But here's the air pocket theory that people are getting worried about. If the disruption happens too fast, if all these legacy companies get destroyed before the new AI native companies can really scale up and monetize, you might see a pause in that CapEx spending.
Oh.
If the tax bots and the trucking bots are massively deflationary and drive prices for services down to zero, where does the profit come from to pay for the $30,000 GPU?
So the underlying fear is that AI is actually deflationary for the broad economy, even if it's been inflationary for tech stocks. And eventually that economic deflation comes back to hurt the tech giants too.
Exactly. If the blast radius gets too wide too quickly, it ends up destroying your own customer base. NVIDIA needs to come out next week and show the world that their chips aren't just destroying old industries, but that they are creating new, highly profitable ones that can sustain this incredible level of spending. It is the sustainability test.
So if the middlemen, the intermediaries, are all dying, and the big tech giants are under this intense interrogation lamp, is anyone actually safe? Is there a business model that actually benefits from all this without being priced for perfection?
Surprisingly, yes. And it's the company that, for most people, defines the old economy.
Who's that?
Walmart.
Walmart, the big blue box, the place I go to buy socks and groceries.
While the tech sector is stumbling, while the brokers are crashing, Walmart stock is hitting all-time highs. It's outpacing the S&P 500 by over 20% right now.
Okay, you have to make that make sense. Why is Walmart suddenly the AI darling of Wall Street?
Because of this crucial distinction between the displaced and the adopter. Think about it. Walmart owns the physical assets. They own the inventory, the warehouses, the trucks, or at least they control them. You cannot download a gallon of milk from the internet.
Right, you still need the physical object. You can't 3D print a banana in your kitchen. Not yet, anyway.
So when a new AI tool comes along that makes logistics 70% more efficient, like we saw with the Semicab story, Walmart doesn't lose its business. Walmart uses that tool to lower its own operating costs.
Oh, I see. C.H. Robinson loses because their entire product was the service of logistics coordination. Walmart wins because they are a buyer of logistics coordination. If the cost of that coordination goes to zero, Walmart's profit margins go up.
Precisely. Walmart has this internal strategy they call tinkering becomes transformation. They are using AI aggressively to optimize their supply chain, to predict inventory needs on a store-by-store basis, and to automate their pricing. The market views Walmart as having a physical moat that AI actually widens and deepens.
That is such a crucial mental model for you, the listener, to use right now. You have to ask of any company, do you sell the process, which AI will eventually do for free, or do you sell the final result, which AI just makes cheaper for you to produce?
That's it exactly. If you sell the process, the tax filing, the freight matching, the writing of basic code, you are in deep trouble. If you sell the physical good or the final experience and you can use AI to strip out all the process costs in the middle, you are a huge winner. It's all about asset ownership versus process management.
And just briefly, speaking of resilient business models, I saw a note in the research about diabetes and longevity still being a hot theme. It seems like the only things people are willing to bet on right now are AI and weight loss drugs.
It's the barbell trade of the mid-2020s, isn't it? On one end of the barbell, you bet on the machines taking over everything. And on the other end, you bet on humans wanting to live longer and look thinner. The healthcare innovation theme, specifically GLP-1 drugs and this whole diabetes ecosystem, is seen as the other major parallel growth track that is somewhat insulated from the tech hardware cycle. It's a biological moat, if you will.
A biological moat. I like that. So we've covered the domestic situation pretty thoroughly, but we can't have a conversation about AI without looking at the global picture. And there was some news out of China that I think flew under the radar for the average person, but the real geeks in the space are freaking out about it.
Oh, yeah. Alibaba released a new model called Q 3.5.
Qwen. That's QWEN. This dropped pretty quietly in the mainstream press, but the technical forums and AI Twitter are on fire about it. What is this thing?
It is a massive, massive deal. Alibaba released Qwen 3.5, and on paper, it's a 397 billion parameter model, which is huge. But the raw size isn't even the main story. The story is the architecture. It uses a mixture of experts model, or MOE.
Mixture of experts. We hear this term thrown around a lot. What does it actually mean for how the model works?
Okay, think of it this way. Imagine you have a panel of 50 different experts sitting in a room. You have a mathematician, a poet, a computer programmer, a lawyer, a biologist, and so on. In a traditional dense AI model, like the early versions of GPT, when you ask a question, all 50 experts have to wake up, listen, and think about the answer, even if the question is as simple as, what is 2 plus 2?
It's incredibly inefficient. You're burning all that energy waking up the poet just to do simple math.
Right. You're waking up the entire brain for a very simple task. In a mixture of experts model, there's a router at the front. The router looks at the prompt and says, oh, this is a math question, and it only wakes up the mathematician. The other 49 experts stay asleep, saving energy. Qwen 3.5 has 397 billion total parameters, but only about 17 billion are active for any given query.
So it's drastically faster and much, much cheaper to run.
They are claiming it's 19 times faster than their previous model, but here is the interrogation angle that loops all the way back to our market fears in the US. The API cost for this model is 0.4 cents per million input tokens.
40 cents.
Yeah.
It's effectively free. It's a rounding error.
It is the commoditization of cognition. And this is a Chinese model, which is effectively open weight for researchers. If China can flood the global market with high IQ intelligence at a price of 40 cents, how does a company like OpenAI or Google protect its premium pricing and its margins?
It becomes a race to the bottom. If intelligence is just a commodity, like electricity from the wall, you can't charge a premium for it anymore.
And Qwen isn't just cheap. The benchmarks show it's incredibly agentic. It rivals the latest GPT-5 class models in its ability to actually control computer interfaces. It can write code. It can fill out spreadsheets. So now you have this geopolitical angle to the disruption. The cost of replacing white-collar labor is dropping much faster than anyone predicted because of this intense global competition.
Which brings us full circle right back to the blast radius. If the cost of the AI agent that replaces the tax accountant or the freight broker is dropping to 40 cents, the disruption is going to happen even faster than the regulatory system or the market can possibly absorb.
That is the ultimate danger. The speed of the price drop in digital intelligence is now outpacing the speed of corporate adaptation, and that gap creates immense volatility.
So let's try to synthesize all of this for the listener. We've covered a lot of ground today, from the charts breaking down to the trucking crash to the Walmart pivot to these new Chinese models. What is the one key thing the listener needs to take away from this new interrogation phase of the market?
The big takeaway is that the word legacy is no longer a safety net. In the past, buying a legacy company meant you were buying stability, a long history, a trusted brand. You know, the old saying, nobody gets fired for hiring IBM.
Right. It was the safe choice.
In the interrogation phase, the word legacy often just implies a heavy, bloated cost structure. It implies that you have thousands of human employees doing jobs that an AI agent can now do for pennies on the dollar.
Legacy is now a liability.
It's a liability until proven otherwise. The burden of proof has completely shifted. You, as a company, now have to prove to the market that your human workforce is adding a unique value that the AI absolutely cannot touch. If you can't prove that, like the freight brokers couldn't, the market will reprice you instantly and without mercy.
Valuation interrogation.
Mm.
It really is a sobering thought. We are moving from a market that rewarded promises about the future to a market that demands receipts right now.
And those receipts better show that you are the one holding the hammer and not the one that looks like the nail.
I just want to leave our listener with one final thought here, something that really stuck with me as I was looking at that C.H. Robinson chart.
Go on.
We saw a 100-year-old industry, the trucking brokerage industry, get repriced downwards by 20% in a single day. One day. And it was all because of a press release from a tiny startup about a tool that might work. It wasn't even a tool that taken over the world yet. It was just the idea of the tool.
It's the speed of the repricing that is completely unprecedented.
Right. So if that is the market's reaction to a single press release, what happens when these AI agents start actually executing these tasks at scale? What happens when the empty miles actually do start to disappear from the system? Are we looking at a future where legacy status, being an incumbent, having a long and storied history, is actually a dangerous liability?
That is the provocative question we're all grappling with, isn't it? In the past, legacy meant stability. It meant trust. In this new interrogation phase, legacy might just mean target. It implies you have a heavy cost structure and a business model that an agile, low-cost AI agent can systematically undercut.
A liability, not an asset. That has to be a terrifying thought for a lot of executives sitting in boardrooms today.
And a very fascinating one for investors.
Indeed. Well, we will be watching that NVIDIA print next week closer than anything else. I think it might just determine the direction of the entire year. But for now, stay safe in the blast radius. Thanks for joining us on the ProTicker Deep Dive.
Thanks for having me.